recycle it and purify all this stuff. So there's been a discussion. I was actually this weekend over with a discussion with a bunch of I consider to be very intelligent people that were trying to plan, or trying to hypothesize of where they thought the world was going to be. And one of the viewpoints was that it's going to be a better place because whenever we get to a certain problem threshold, like when we saw oil was at what, 160 a barrel, that so much capital flowed into that industry. It helped spur more economic development and helped spur other avenues for energy creation. And so what's, I guess, swirling in my head is your 30%, I guess, head start, if you will, from the government and this economic disparity. Where is the break-even point, do you think? So that's one question. And the second question is how it used to just, as you said, just be about the economics. Like at some point, it was like, once we get to a higher economic trade-off, the investments will flow. You just won't be able to help it. It will happen. But there's been much more of a desire for the other side. And if you're leading, or at least putting up, all of the impact statistics as well, how much has that really affected the money flow? Like, is it like, what percentage? Would you give me a guess of like percentage of decisions that people make on the impact metrics versus the actual just solely economic metrics? It used to be 99-1. Like, what do you think it is now?
Right. So, so on the second question, as you said, 99-1 might have been a generous estimate, because people, in the past, people just made a distinction between what their investments were and what their philanthropic activities were, right? There wasn't a lot of opportunity to blend the two. Now you have an opportunity to, and I particularly, talking to foundations and endowments here, right? I mean, if you have a mission to provide some social good, why not have the preponderance or all of your investment portfolio likewise targeted toward that positive social outcome or other positive social results, environmental results, et cetera. And so we're seeing more and more of that come into the calculus. But it really is on a case-by-case basis, right? We're talking broadly, it's increasing, but I think on a discussion by discussion basis, there are some investors that are still that are interested in what we're doing purely because of the economics, because they have an interest in energy more broadly, because they have an interest in real estate, and investment areas, commercial areas that are sort of adjacent to renewable energy. There's sort of a natural affection for or an interest in what we're doing, and so you have that. And then there's other folks that find us or find us interesting because of the impact side, because they've gone through the process of doing a values assessment, and particularly as they've been talking for years about the great wealth transfer from the boomers to the next generation, and as that upcoming generation gets more involved with investment decisions, that as a generational matter, that younger cohort is more interested in the impact, both negative and positive, avoiding negative impacts and creating positive impacts of how they invest their money. So there, it's always evolving. It's different for every discussion, but as a general rule, it's definitely increasing in how investors look at what we do. From the first question, it's each of these markets are super interesting. I think we've looked at plastic recycling, and you mentioned working for Goodyear, the recycling of tires, and I can remember as a kid, tire fires that took years and years to go out, and how the government addressed that, and there have been little publicized programs or long forgotten programs perhaps that have incentivized, greater recycling of certain materials, tires, right? The core charges and things like that. And they've done the same thing with computers, right? Where they're charging a recycling fee, they're building that into the price. Plastics are likely going to see some other mechanism where there's actually an economic cost that's tied to plastic pollution or plastic waste that's gonna prompt greater recycling of those materials and perhaps put recycling economically on the same footing as virgin materials. We're going to see the same thing, I believe, in water, where water is going to be increasingly scarce, and there's going to be a way to trade water conservation the same way we can trade carbon credits today, either voluntary or involuntary. And then, of course, in the renewable energy markets, it's interesting. The 30% has been in play for solar and wind power for quite some time. Certain other technologies as well benefited, perhaps to a lesser extent. But what the Inflation Reduction Act did was that it allowed virtually all renewable energy technologies to take advantage of that 30%. So it broadened the usage of the credit, and at the same time it extended the credit for a longer period. So it increased the access to the credit, and then it gave greater visibility around the credit, because typically these credits aren't used by the people who have who've developed the project or own the project in the long term. They're securitized and sold, or they're monetized in some other way, so that they can be utilized by folks who have tax liability. So that's an important element to that market, creating more efficiency and clarity in that credit market. But we've been working on this fund for nearly a year. And so we started it well before and formulated our investment theses well before that credit was available for the types of projects that most of the types of projects that we work on. And those projects were able to stand on their own economically before the 30%. The 30% just makes it a lot easier to reach economic hurdles and reduces, it de-risks really, because you're reducing the equity investment that you're making, and so that equity investment can withstand greater fluctuations in cash flows to meet the targeted return. So that's how I look at it. It substantially de-risks the investments, and it does so for an extended foreseeable period of time, and so that's there is certainly an economic benefit, but that risk reduction really is, I think, what is most important for most investors as they consider renewable energy, a segment that they might not otherwise have been have much experience with or be thinking about. There's definitely a reason to, outside of the environmental considerations, there's a good reason to consider the segment and to learn about it, and so that's a lot of what we do, is just educating folks on what are these technologies, how do they work, what are the economics around them, those types of things, because it's a familiar space, but it's not a space that people have deep experience in necessarily.
Yeah. So if a family office wanted to pursue an impact investing strategy with renewable energy, how would they go about doing something like that?
So, for us, like I said, I think it is difficult to pursue an impact strategy around renewables in a public format. There's certainly publicly traded companies that have direct, whether they're manufacturers or owners of those types of assets, manufacturers of different various components, et cetera. That's one way to invest in the segment through public investing. I think the best way to invest in the actual ownership of projects is through a private investing, and that at least is true for now, and that's partially because there's not a tax efficient way to own these projects in a public format. Our fund is a limited partnership. We pass through the income without a corporate level of tax. If we tried to do the same thing in a public structure, we'd incur a corporate level of tax, and so it would reduce the returns. So there's no renewable energy REIT that you can own today, right? Where there's a tax-free pass through. The energy equivalent would be the oil and gas master limited partnerships, or MLPs. That's not available today. So again, I think the most efficient way to invest these projects is through direct investment or through private investment, a fund. And because scale is so important, I'm self-interested here because we run a fund, but I think that because scale is so important, and it continues, particularly the commercial segment in renewable energy is so fragmented, that it's important to have somebody who's in the market like Windmill full-time, talking to developers, working with them, understanding the landscape, understanding the development issues and supply chain issues, and seeing a greater flow of opportunity, and then also being able to aggregate capital from different investors in order to create that scale. And again, I think that there's tremendous impact as well as economic value in creating that scale. And so pooling capital with other families, high net worth investors, et cetera, is that creates that opportunity. So there's a few of us out there that are in this space, and so it's locate guys like us that and find one, and then from there it's your typical sort of manager diligence. I mean, beyond that, it's even though there's an impact element, and we write about this quite a bit. We've talked to a lot of family offices and stuff, and there's from a diligence standpoint, it's the same type of process, and it's just as important running diligence for a private renewable energy manager as it is to run it for any other hedge fund or other private manager that you're going to be working with, and perhaps even more important, really, than because you want that manager's values to align with the values that that's, if it's an impact oriented investment, you want those values to align as well as the business acumen and experience and those sorts of things. So diligence, like I said, maybe even more important for in the impact space.
You did leave off of one benefit that's glaring for me as an asset allocator. You mentioned REITs. I had started a REIT of golf courses once in the late 90s and imploded upon itself. But if you look at the history of REITs, the whole point was underlying real estate tends to not move in conjunction or lockstep with the stock market or with the bond market. But so the correlations for real estate 20, 30%. But now publicly traded REITs will often trade in the 80 to 90% with the public markets, even though the underlying real estate's not correlated at all.
Right.
So I imagine it would be a very similar situation as a private investment, that especially a longer term private investment that are marked to market, over longer periods of time. You have much less volatility, much less fluctuation, that much greater diversification benefits than you would if you were investing in a privately driven or a publicly driven company.
Yes, no, and I think that's particularly timely comment given what you mentioned before. We don't really know what's going to be happening with rates. The inflation picture is murky. Global geopolitical environment is complicated. All of which is headwinds for the public markets, and whereas in the private markets we're the circumstances on the ground are quite different.
Exactly right. Can you tell me a little bit about your before we wrap up, about how somebody would invest in your fund? You have, tell me, is it one fund? Do you have multiple funds? What are the minimums? What are the lockup periods? Those kind of things.
We have we have one fund that we're managing now. It's our first fund, so we're very excited. It gets 100% of our attention, 110% maybe. Yeah. It is targeted towards family offices, foundations, and endowments. There's a $1 million investment minimum that can be waived by us as the manager. It's a 5-year fund with 2 1-year extensions. So the notion is, as I said, to aggregate assets and then capitalize on the portfolio premium as I see it, and I think that there's a lot of evolution that's happening in the energy markets more broadly. These independent power producers are going to be a completely new sector, and so I think that we've got multiple exit opportunities. But it's it's all locked up. There's no redemption period. But like I said, it's a relatively short term fund for a much longer term investment. And our focus in that fund is the ownership of operating assets. We intend to buy assets upon completion where we are putting our capital in concurrent with the commencement of operation of that asset and the cash flow from those operations.
Well, it's fantastic. Brian, it's been great having you on the show and learning about the evolution of impact investing and how renewable energy could fit into your investment portfolio. I hope the audience learned a lot. I know I did. It was fantastic. How can people get a hold of you?
We are on the web, as you said, windmillcapitalmanagement.com. A little bit of a mouthful, but once you type it the first time, then you don't have to type it anymore. Windmillcapitalmanagement.com. You can connect with us there. And then of course, LinkedIn. I think the company and my personal LinkedIn information will be included below.
Yep. I am sure we'll put the links down below in this recording. And if you think you'd make a good guest on Money Talk Viewpoint, please reach out to Chantel Leeson. The information there will be below. Learn more how you can get involved with getting your ideas out to financial professionals, advisors, other centers of influence, so that we can all become better informed and make the world a better place for generations to come. My name is Stuart Kruse, and it's been a pleasure to be your host on this show.